Welcome to this explainer. Okay, today we're diving into the pretty treacherous and honestly often confusing landscape of commercial financing. If you're a business owner, you already know the pain here, right? Acquiring new machinery isn't just about picking out the coolest tool for the job. It's a high-stakes financial maneuver. It directly impacts your cash flow, your tax liabilities, and literally your entire bottom line. I mean, getting this right can absolutely catapult your growth. But getting it wrong, well, that can sink your margins for years. So we're going to break down the exact strategies you need to protect your capital and make the smartest acquisition possible.
Now, this right here is the central dilemma every single business owner faces. You need critical, expensive machinery to stay competitive, speed up your production, and actually fulfill all those incoming orders. But how do you get it onto your shop floor without totally bankrupting your operating account? Do you deplete your hard-earned cash reserves to own it outright? Or do you sign a contract to rent it over time? Look, getting this answer wrong can completely paralyze your business growth because you end up tying up funds you desperately need somewhere else.
Okay, let's dive into this. Here's our roadmap for today. We're going to cover 1, the equipment acquisition dilemma, 2, financing versus leasing explained, 3, decoding equipment lease types, 4, beware the hidden fees, 5, tax shields in Section 179, and finally, 6, making your final decision. Let's get right to it.
Section 1, the equipment acquisition dilemma, balancing tight cash flow with critical operational needs.
So every single day, you have to balance preserving your cash for daily operations, buying raw inventory, funding marketing campaigns, paying your skilled labor. You're balancing all of that against the urgent, undeniable need for productive modern equipment. It's a constant financial tug of war. A huge part of this dilemma really comes down to the actual lifespan of your asset. You've got to consider both the physical and the technological longevity of what you're acquiring. For example, think about a traditional cast iron sliding table saw. That physical asset, it can remain highly competitive and hold its resale value for literally decades. But then, contrast that with a digital asset. Take a 5-axis CNC router that heavily depends on rapidly evolving computing power and software. Those things become functionally obsolete in, 3 to 7 years. The technological lifespan of the machine you're eyeing should absolutely dictate your acquisition strategy. You definitely do not want to be locked into a 10-year loan on a piece of machinery that's going to be a giant paperweight in 4.
Let's move to Section 2 and see how this builds. Financing versus leasing explained. The fundamental fork in the road.
Okay, so once you know exactly what kind of asset you need, you reach this foundational fork in the road for acquiring it without draining all of your capital at once. At its core, the difference really just comes down to ownership and equity. With equipment financing, you're taking out a self-secured loan to purchase the machine. You take immediate tax ownership, and once you make that very last payment, you own the asset outright, free and clear. That free and clear ownership matters immensely. Why? Because you're adding a tangible asset to your balance sheet that you can leverage later or even sell to recoup some capital. Now, with leasing, on the other hand, it functions much more like a structured rental agreement. You're paying the lessor a monthly fee for the right to use the asset for a specified term, but they retain the ownership. You're paying for utilization here, not equity.
All right, Section 3, decoding equipment lease types, finding the right structure for your balance sheet. Now, if you do choose to lease, the complexity is kind of just beginning because not all rental agreements are created equal. You've got operating leases where you basically just return the machine or buy it at fair market value at the end of the term. But then you have capital leases and $1 buyout leases, and those function a lot more like disguised loans. Now, what's really interesting about this distinction and why it's so critical for your company's financial health is that thanks to recent accounting rules known as ASC 842, capital leases are essentially forced onto your balance sheet as funded debt. This directly impacts your company's leverage. If you take on too much of this specific kind of debt, it could completely upset the strict borrowing rules or covenants you already have established with your bank. That could potentially freeze your lines of credit. Operating leases, while they do appear as a right-of-use asset, are classified as operating liabilities. This gives you just a little bit more flexibility and breathing room for your leverage ratios.
Section 4, beware the hidden fees, exposing the monsters in the fine print.
So the equipment leasing industry is filled with totally reputable lenders. Sure, but there are also predatory traps designed specifically to inflate the leaser's profits way beyond that attractive monthly payment you were originally quoted. First up is the dreaded evergreen clause. Guys, this is one of the most dangerous traps in commercial leasing. It basically states that if you fail to notify the leasing company of your intent to terminate the lease, which usually requires you to send certified mail within a bizarrely specific narrow window, like exactly between 90 and 180 days before the lease ends, the contract just automatically renews, usually for a full year. Yes, in the era of digital signatures and instant communication, they are literally hoping you forget to send a physical letter just so they can lock you in.
And the crucial point is, a simple administrative oversight like that can be absolutely devastating to your cash flow. Take this real-world example of a medical clinic that leased an $80,000 diagnostic machine. The clinic manager was, busy running the day-to-day operations and just missed that narrow 90 to 180-day notification window by a few weeks. The result? The lease automatically renewed, locking them into an extra $30,000 in completely unwanted, non-negotiable payments for a machine they were actively trying to return. Just brutal.
Another heavily disguised trap is interim rent. Let's say you receive your shiny new equipment on the 10th of the month, but your official billing cycle doesn't formally start until the 1st of the following month. Well, lessors will rightly charge you for that interim period where you actually have the machine. The trap, however, is that they frequently do not prorate it. For example, a cafe owner once received a commercial espresso machine on June 10th, only to be slapped with a full $950 monthly payment for just 20 days of use before the real lease even officially started. Always, always demand that interim rent is prorated daily before you sign on the dotted line.
And hey, if you think returning the equipment at the end of an operating lease is a walk in the park, beware of what we call the triple threat. The logistics and the costs are almost entirely on your shoulders. You have to pay completely out of pocket for professional deinstallation, custom rigid crating, and insured freight shipping across the country to a facility that the lessor actually gets to choose. Then, once it arrives, you face highly subjective excessive wear and tear penalties. Breathe on the machine wrong and it'll cost you dearly. And to add insult to injury, lessors often just continue billing you your monthly rent while the machine is sitting in their warehouse waiting to be processed.
Section 5. Tax shields and Section 179, your ultimate financial sword and shield.
All right, so how do we fight back? Well, we use the tax code to optimize the acquisition. But before we get into the actual numbers, remember this really stark warning from agricultural accounting experts. A write-off doesn't make bad math good. Never ever buy a piece of equipment simply because you had a profitable year and just want to avoid paying the IRS. You must actually need the machine for your operational growth and efficiency. Sure, taking a massive deduction today might feel great, but it could leave you with a hefty, totally unmanageable tax burden in future years while you're still obligated to make those monthly loan payments. Now, if the math is good and you truly do need the asset, the benefits are staggering. For the 2026 tax year, the Section 179 deduction limit is a massive $2.56 million. And with recent legislation in the OBBPA of 2025 restoring 100% bonus depreciation, you can potentially deduct the entire cost of fully financed equipment up front. This is incredibly powerful. You get the machine on your floor, you keep your working capital safe by only making smaller monthly payments, but you get to claim the massive tax shield in year one exactly as if you paid in cash.
However, please do not get caught on a technicality and lose this benefit. Simply signing the contract in late December is not enough. To claim these tax shields, the asset must be physically delivered, fully installed, and fully operational, which is what the IRS explicitly calls being placed in service by December 31st. If you bought it, but the machine is delayed and just sitting in a shipping container on New Year's Eve, you completely lose the deduction for that tax year. When it comes to this, timing is absolutely everything.
Section 6. Making your final decision. Calculating the true net cost.
So how do you actually compare a lease quote versus a loan quote side by side? Look, relying on nominal monthly payments is a total illusion. You need a formula that respects the time value of money. First, add up your total upfront costs. This includes down payments, security deposits, and origination fees. Second, add every single monthly payment you're going to make over the entire term. Third, and honestly most importantly, add your lost interest. This is the opportunity cost. Ask yourself, what return would you have made if you kept that hefty down payment invested in your core business, in marketing, or in inventory? Finally, if you're buying the asset, subtract its estimated market value at the end of the term, since you can always sell it. That resulting number, that is your true net cost. Run that exact formula for both the lease and the loan to see which actually cost your business less in the long run.
So, as we wrap up, I'll leave you with this provocative question to really ponder for your own business. What is your ultimate cash flow priority right now? Are you building long-term equity in assets that will reliably last for decades? Or do you need immediate liquidity to survive a tight season while utilizing rapidly changing technology?
Audit your next quote, question all those hidden fees, and never let the fine print dictate your balance sheet. Thank you so much for joining me for this explainer, and we'll see you next time.